Hi, this is Karen Lin. In this video, I'm trying to guide you through inter-entity inventory cells. Let's first talk about the intuition of consolidation when we're looking at intra-entity cells among a entity. So when we talk about intra-entity cells, we refer to the cells that are happening between the parents and the subsidiary. So remember, when the parents acquires more than 51% of the subsidiary, the parent basically controls the subsidiary via voting rights. So we call these two parties, the parent and the subsidiary, now one entity. So this box here represents one entity of the parent, consists of the parent and the subsidiary. So now when we see there are some transactions happening between the parents and the subsidiary, from the entity's perspective, which means from the outside investor's perspective, those transactions do not happen or do not exist. The reason is because think about one company. If a company has more than one divisions, in in any 10Ks, you won't see the two division transaction appear on a 10K, right? That is because from the outsider's perspective, they are only interested in the overall financial status of this one entity rather than any sales incurred between the two parties in the entity. The other reason is that if we do not ignore the transactions between the two parties when we consolidate, we may end up with a financial statement that reports um, the transactions between the two. More importantly, by marking up the goods that one party sells to another, the entity could basically inflate the whole entity's assets, revenues, and so on. So we do not want that to happen because the parent controls the subsidiary. Any sales between the parent and the subsidiary are not viewed as arm's length transactions, which means it's not basically market transactions under the market conditions. So we want to ignore those when we try to consolidate the financial statement. That's the mandate of the GAAP. So let's take a look at this very simple example. When the parent got some inventory from outsiders by $40, right? The parent sells this inventory to the subsidiary for $100. You can see the parent basically records a $100 sales and $40 cost of goods sold. So this transaction basically increases the parent's net income by $60, right? So, however, the subsidiary didn't sell anything in among this inventory to outsiders. That means there's no exchange between the subsidiary to the outsiders. So if we look at the box, the idea is that if you look at the box, you realize that there's only an inflow of $40, but there's no outflows. So there's no transaction basically, or no exchange between the box and the outside environment. So in that case, we do not consider the $100 sales between the parent and the subsidiary sales from the entity's perspective. Also, the parent recognizes a $60 gross profit that's also not existed. So when we consolidate, we try to eliminate the effect of this 100 minus $40, which is $60 impact on the parent's financial statement because it is a related party transaction. You could understand it in that way. I'll give you a more extreme example. If we don't ignore this transaction, for example, when we consolidate, there could be an extreme case where the parent got this inventory for $40, right? But selling this inventory to the subsidiary for $1 million. You can see $1 million minus $40, that's a huge gross profit that would be affecting the parent's income statement. If we don't eliminate the impact of this $1 million minus $40 gross profit, you may mislead outside investors, let them think the parent make a lot of money, but the parent actually didn't because the parent only transferring some inventory or some even useless goods to the subsidiary because it has the voting, it has the control over the subsidiary. So when the parent can control the subsidiary, it can basically sell anything it wants to the subsidiary by voting. So that is just an unrealistic, unrealistic example, radical example. But that tells you why we need to eliminate the gross profit between the two parties when the other party didn't sell it to outsiders. Okay, so in this case, there's no sales happen from the entity's perspective, and the $60 recognized by the parent is basically regarded as unrealized gain and has to be deferred until the subsidiary sells all the inventory to outsiders. Okay, so that's the first idea. There could be unrealized gain if these two parties are selling stuff between each other but didn't sell those stuff to outsiders. Another scenario is the parent got the inventory for $40 and selling to the subsidiary for $100. The subsidiary sells all these inventory to outsiders for $250. Okay, in this case, we will see that the $60 recognized by the parents is actually basically realized because the subsidiary sold everything to outsiders. Okay, now from the entity's perspective, there is the sales. The sales is the $250. That's from the sub to outsider. And there is the cost of goods sold. The cost of goods sold is from the outsider to the parent. So it is how much you originally, this whole box, right? This whole box originally got the goods for. So from the box perspective, the total profit for this transaction would be 250 minus 40, that's 210. Now, how does that profit distributed between the parent and the subsidiary? The parent recognized 60, right? 100 minus 40. The subsidiary recognized 250 minus 100 because when the subsidiary got the inventory, it's worth $100. And the subsidiary sells to outsiders for 250. So the subsidiary recognized 150 on its income statement. So 150 here and 60 here. 150 plus 60, that's 210. Now 250 minus 40, that's 210. We can see if there is an intra-entity sales, the gross profit of selling this inventory will be split between the parent and the subsidiary. Okay, in the first scenario, there is no sales happen for this whole box. So there is no profit should be recognized from the entity's perspective. In the other case, the entity would recognize 210 for this transaction. So I'm going to illustrate another point, which when partial inventory are sold to outsiders. So this is another case. This is an upstream sales, which means it is from the subsidiary selling to the parent. The subsidiary got the inventory from outsiders for 35,000, selling it to the parent for 50,000, right? The parent selling it only portion of this 50,000 to outsiders, which the parents sold 40K out of 50K to outsiders. That is actually 80% of the inventory where it got from the subsidiary. So again, the subsidiary sells to a parent some goods, 35K for 50K, and the parents sold for 80% of this 50K to outsiders for 70K. But there is another 10K left with the parent, and it's not sold. Now you can see from our demonstration before, if that's the case, only the 80% sold to the outsiders are considered realized, and the 20% that's left with the parent, any gross profit contained in that is considered unrealized. Okay, so before we talk about consolidation, we first need to talk about the parent and the subsidiaries bookkeeping process, because when we consolidate, now you can easily imagine in your worksheet, there are the first two columns, right? The first column is the parent's number, the second column is the subsidiary's number. So when we consolidate, the first thing we do is the parent's number plus the subsidiary's number, P plus S. When you do P plus S, you need to do some adjustment, but your benchmark or your baseline is the parent's number and the subsidiary's number. So let's take a look at the parent and the subsidiary's bookkeeping. The subsidiary selling to the parent, so the subsidiary debit cash credit sales 50,000. And the subsidiary also recognized the cost of goods sold and the removal of the inventory, so 35,000 on both sides. So this is the subsidiary's financial accounting. You can see from here the subsidiary recognized 15,000 gross profit. Basically, its impact to its income statement is $15,000 here. Now, the parent, who is the buyer, got the inventory, debit inventory 50,000 and credit sales 50,000, credit cash 50,000. Okay, that's the parents getting the inventory. And then when the parents sold the 40,000 out of, now notice that the inventory originally was 35,000 on the outside, on the subsidiary's book. Now when it transferred to the parent, it is inflated to 50,000. So when the parent got the inventory, it becomes 50,000. So that's an inflation of the inventory that you want to consider removing if at the end of the period those inventories are not sold to the outsiders. When the parents sold the 80% of the inventory to outsiders, it debit cash credit sales 70K, which is here. The 70K, that's the parent sold to the outsider. And then recognize cost of goods sold 40K out of the 50K, right? So you can see the inventory parent got was 50K, and then they sold 40K. That means there's a 10K left in the parent's warehouse that's not been sold. In the meanwhile, I'm not sure if you remember chapter 4. I wonder whether you remember chapter 4. If you remember, the parents actually need to recognize the unrealized gain that's contained in the remaining inventory, which because it's not sold. So again, anything that's sold to the outsiders are realized, but any markup in this inventory which is not sold to the outsiders and kept with the parent, that's the 10K, is not realized. So how do I know which part is unrealized? There are two ways to calculate it, right? The first way is use your intuition. The seller is the subsidiary. The seller mark up the inventory by 50K minus 35K, right? 50K minus 35K, so that's the markup. So the seller actually mark up this inventory by 15K, okay? And there are a portion of this markup that is not realized. How much is not realized? It is the remaining inventory over the total inventory. So which means, again, as we said before, 20% is unsold to outsiders. This is the 20%. 20% is unsold to outsiders multiplied by the gross profit markup by the seller. So that's the 20% multiplied by the 15K. That's 3,000. Okay, so that is the first way you can calculate the unrealized gain. Once you know the unrealized gain, the parent adjusts the unrealized gain, debit equity in net income, credit investment. So the parent basically needs to adjust its investment and equity in subsidiaries net income account to account for the fact that a part of the intra-entity sales has an impact to the consolidated financial statement or the seller's, in this case, the subsidiary's financial statement, which is not realized. And the second way to calculate is more mechanical. We want to calculate the gross profit rate, which means it's the percentage markup based on sales. Now, remember, it's based on sales if you are calculating GPR. If you see in your homework or in an exam, it says the markup based on cost of goods sold. You cannot calculate, you cannot use sales minus, you cannot think that is the GPR, okay? Let's say it has been marked up for 20% over the cost, then that 20% is not GPR. GPR is the markup above, based on sales. So here, GPR is basically sales minus cost of goods sold by the seller, which means in this case it's a subsidiary, it's an upstream case. So sales minus cost of goods sold divided by sales, that's 30%. This means the subsidiary basically mark up its inventory based on the sales price, 30% of the markup. And how much is the unrealized gain? The unrealized gain is to how much gain is unrealized is to find out in the remaining inventory 10K, right? In the $10,000 remaining inventory with the parent, because the parent sold 40,000 out of 50,000. There is a $10,000 inventory remaining. So by this $10,000 remaining inventory, we are going to find out how much markup based on sales price it is contained in this 10,000. Okay, now you see why your denominator is sales, because this $10,000 is based on the sales between the subsidiary. If you look at this is basically the sales of subsidiary, right? The 10,000 out of 50,000 is on the scale of, or using the baseline of the sales number of the subsidiary. So here, the unrealized gain is the remaining inventory multiplied by the GPR, 30%, which means in the remaining inventory, there is a 3,000 markup based on sales price. So that part should be adjusted. Now, again, these two are alternative methods. I personally like the first one because it's more intuitive. But sometimes if you're given GPR already, you should be using the remaining inventory multiplied by the GPR, which would be easier. Okay, so that is the idea of the sales, the bookkeeping of the two parties transactions. Now let's take a look at the consolidation. Let's look at consolidating financial statements. Remember the first two columns of your worksheet. The first column is the parent's number, the second column is the subsidiary's number. So if you look at the subsidiary selling to the parents, the subsidiary, basically what I'm doing these two columns here is just to post all these entries to a financial sort of statement format. Basically, if you remember your financial accounting, it's posting those to your general ledger, and then you go to the trial balance, and then you prepare your financial statements. So this is what it is about. Now, this portion is only the impact of the intra-entity transaction, which is basically the way that we are going to express or doing the consolidations in this chapter. So I want you to know that the parent and the subsidiary may have other sales. They may have other sales that they are conducted with outsiders all the time. But these two columns are only about the impact of the intra-entity transactions we are talking about. So they didn't contain other transactions here. It is only talking about the impact of the intra-entity transactions we have been discussed so far. Okay, so if I post those journal entries to these two columns, you will see that the subsidiary has the sales 50,000, cost of goods sold 35,000, and the impact to the net income is 15,000, which is basically the gross profit from the transaction. For the parents sold 80% out, right? 80% out of 50% to outsiders. That's the 40K. Cost of goods sold 4 or 70K sales. So $70,000 sales. And the impact to the parent's net income is 30K. And the parent also has 10,000 inventory left in its warehouse. Now, what is the consolidated balance of this two columns? If you're watching this video, I'm going to ask you to pause the video to think about what should the consolidated balance be. Because if you're thinking about the consolidated balance, I'm going to give you a hint. You would be thinking in terms of this box. Okay. So for example, what is the sales of this whole entity? It has to be the sales to outsiders, which means it's the 70K. What is the cost of goods sold of this entity from the point of view of the entity? It is the 35K, but the parent didn't sell 100% to outsiders, only 80%, right? 80% out of the 50K. So the cost of goods sold to this whole entity is basically 80% of the 35K. Okay, you need to think in terms of the box. Okay, so that's what I'm saying. The total sales for the entity is 70K. The cost of goods sold is 28K, which is 80% of 35K. The net income impact 70 minus 28, that's 42K. Inventory from the box's perspective is not 10K. It is basically the 35K. Remember the cost of goods sold? Basically the 35K. 80% is sold, right? 20% left. 20% of the 35K, that's 7K. So that is why the remaining inventory should be 7,000. So if you think about 7,000 plus the 28,000, that's 35. So which means of inventory available for sale, it's either becoming cost of goods sold or stay as inventory. So these two should be added up to be inventory available for sale. All right, so that's what it should look like when we consolidate. Now, obviously, if you do P plus S, it wouldn't lead you to the correct number because when you, as I said, if you don't ignore the transactions between the two parties, you are easily inflating the sales of this whole entity and inflating the cost of goods sold of the whole entity, right? So we are going to eliminate those inflated numbers. So you will see that from P plus S, that's 120, and your consolidated number is actually 70, which means you need a $50 on the debit side to make your P plus S becoming your consolidated number. So on and so forth, you can derive what kind of things that you need on the adjustment column. However, I want to mention that the net income cell, you do not have a adjustment here because the net income number is calculated from the above. Okay, so that you don't need to. So how am I going to do this adjustment? It seems very random, or the number seems not being in a good fashion that I can remember. So I have a way for you to remember. We can use two entry system. The first entry is TI, elimination of the transfer. T means transfer, I means inventory. So transfer of inventory. The TI entry, it's always debiting sales, crediting the cost of goods sold, okay, for the amount of the whole intra-entity sales. Where can you find this amount? If you draw the box as I do, it is the amount within this box between the two parties, okay? It is always this number between the two parties. That is the sales of that is the full amount of the intra-entity sales that you should be eliminating using the TI entry. Some of my students says that, oh, I remember I should use the subsidiaries number, or oh, why are you using the parents number next time rather than the subsidiaries number? That is because you have upstream and downstream. If it's an upstream, it's from the sub to the parents. If it's downstream, it's from the parent to the sub. But either way, it should be the number between these two parties in the cells. So don't try to remember whose number you are going to use. Try to remember the relationship between the two. So we are eliminating the transaction between these two related parties. So that's why when I'm doing TI entry, I'm always debiting sales, crediting cost of goods sold of the full intra-entity amount. Now, why is that important? It's important because when the subsidiary is selling to the parents, this is within the entity, so you want to eliminate that. Okay, again, don't remember that I'm eliminating sales from the subsidiary. You are not. You are eliminating the sales number between the two parties, because if it's a downstream number, next time you're going to switching to using the major's number, parents number. Okay, so do not try to remember which column you're going to use. That's the TI entry. We are eliminating the whole sales and cost of goods sold from the parent and the subsidiary. The second entry we are going to use is the unrealized gain. So because we eliminate the cost of goods sold and the sales between the two, but because the buyer in this transaction, which is the parent, didn't sell everything to outsiders. So when we eliminate the full cost of goods sold, this 50,000 is assuming that the parent actually, I mean the buyer actually get rid of the whole inventory to the outsiders. However, the parent, which is the buyer, didn't. So in this case, there is an unrealized gain that's contained in the cost of goods sold we just eliminated, which we shouldn't be eliminating. So that is the unrealized gain, 3,000 that we should eliminate from the gain. So we would be debiting cost of goods sold, which would be adjusting the over adjusted cost of goods sold in my previous entry. I'm adjusting back 3,000 because I adjusted too much. Okay, I'm going to adjust it back. And the inventory, remember, the inventory shows a 10,000, but it should really be a 7,000. So I'm adjusting this 3,000 back. So I'm debiting cost of goods sold, I'm reducing cost of goods sold, I'm adding to cost of goods sold and reducing inventory. So by doing TING, um, I'm actually eliminating the impact of this intra-entity transaction to the consolidated financial statements. One point is that if it's either upstream or downstream, you should be using TING without differentiation. They should always be the same. So it's the same entry, the same numbers, which it would be the full intra-entity sales and then the unrealized gain. Okay. All right. So if you look at when I post TING here, my consolidated number becomes what I have been predicted in my previous table. All right. Next, I'm going to talk about what happened next year. Okay, I will skip downstream. I'll let you do the downstream case and discuss what happened next year. So let's assume next year, subsequent year, 2016, the parent actually sold the remaining $10,000 inventory to outsiders for 16,000. Now we always assume that inventory turnover in 1 year, which is a reasonable assumption because it's working capital. And also in terms of the TIG and G star, which I'm going to introduce, it's a good system to keep track of. So for now, I just want you to remember that we always assume inventory is sold in the subsequent year. Again, we start with the bookkeeping process of these two companies. The parent basically selling the remaining goods, so it recognized sales, recognized cost of goods sold. The impact would be 6,000 in its income statement. And because the parent sold all these to outsiders, the parent needs to reverse what it has been done in my previous discussion that the parent debit equity net income credit investment for 3,000. Now you could reverse that because when you sell everything to outsiders, when you sell every remaining inventory to outsiders, it's being recognized. So if you look at the subsidiaries entry, it doesn't have sales cost of goods sold because we are only talking about this transaction. There's nothing happened with the subsidiary. But for the parents, the parent actually sells the remaining inventory and recognizes 6,000 in its net income. Now, I want you to pay attention. There is a $15,000 in the subsidiary's retained earnings at the beginning, because last year the subsidiary had recognized the 15,000. We know that there is a 3,000 unrealized gain last period, but the subsidiary recognizes anyway because from the standalone company's perspective, it is okay to recognize those. Okay, so that is the subsidiary's entry, and that's the parent. This is the parent's entry. When we consolidate the two, we see from the boxes, from the entity's perspective, the parent basically, the whole entity sells a $16,000 goods. and also has the net income 9,000. Okay, that's from the entity's perspective. Now you can see the parent only recognized 6,000. Why would the consolidated net income would be 10,000? Um, I mean, the parents recognize net income 6,000 when you do P plus S. How come you have 9,000? Of course, this 9,000 is calculated from the sales minus cost of goods sold. This cost of goods sold is from previous periods remaining inventory on the consolidated total. Remember, if you don't remember, go back to table 5.1. You will see that there is a 7,000 I'm actually referring to table 5.2. There is a 7,000 remaining inventory. So 16 minus 7, that's 9. Now you would say the parent only recognized 6,000. Where do we have the 9? That is the unrealized gain, 3,000 from last period deferred to this period. Okay, I'm going to show you how this works. So how this works is that because the subsidiary has a 3,000 unrealized gain, which they recognize in their net income, but shouldn't be realized last period. So last period, they recognize the $15,000, which contains a 3,000 unrealized gain that they should be realized this period. So how are we going to realize that? We are crediting cost of goods sold. Now, when you credit cost of goods sold increase or decrease? It decreases. When cost of goods sold decreases, net income increases, right? So by crediting cost of goods sold, we are increasing the consolidated. These are adjusting entries. So we are increasing the consolidated net income, not the subsidiaries net income. Consolidated net income are increased by 3,000. Now we are debiting 3,000 from retained earnings at the beginning of the subsidiary because that part should not be in their retained earnings, but should be in their net income this period. So by debiting retained earnings, we reduce the subsidiaries' retained earnings at the beginning for 3,000. Okay. Now, if you combine the two, you will see that what we have done so far is that we basically take the retained earnings at the beginning from the subsidiary for 3,000 out and put it back to the net income of this period. That's what we are talking about here. We basically have taken out something from the previous period and put in here for this period. That makes our net income 9,000, which is a combination of the 6,000 earned by parent when it sold the goods to outsiders and the 3,000 deferred from last period. Okay, so this entry we call the G star. So we are debiting retained earnings at the beginning. We are crediting cost of goods sold for 3,000. By doing so, we basically increase the net income for 3,000 and we reduce the retained earnings of the subsidiary for 12,000. I should actually be writing it here. It should be. It should be, sorry, it should be 0 when you consolidate it because you have the S entry. Okay, so that's why I wrote an S 0 here. All right. So that's the G star. Now notice that if it's a downstream sales, your G star entry should debit investment account rather than retain earnings at the beginning of the parents. The reason is that the parent, if you remember our previous entries, even this is true even if it's a downstream, you will see that the parent basically reduces its equity in net income, reduces its investment for 3,000. So which means the parent already adjusts its net income because this is an income statement account. The parent already adjusted its net income, so it's not in the parent's retained earnings at the beginning. Where is the unrealized gain? The unrealized gain is actually in the credit side of the investment account. So when you're trying to eliminate that, you're trying to debit investment in a downstream case rather than retain earnings at the beginning in a downstream case. So again, I just want you to remember if it's a downstream case, your debit side is investment rather than retain earnings 1/1 of the parent because the parent's retained earnings 1/1 does not have the unrealized gain in it. the unrealized gain is in the investment account rather than the net income. Okay, so I'm going to stop here. In my next video, I'm going to show you how to do a consolidation worksheet, but I'm going to stop here. See you next video.